let's get into it today. We're going to talk about hedging, which is always such an interesting topic, especially on the day where we've reached new all-time highs. Nonetheless, it's important to discuss. We put out a survey, perhaps I believe it was before the session about a month ago, where we asked you what type of strategies you wanted to know more about. There was actually a couple and one specifically that caught my attention. I apologize, I don't have the name, but someone wanted to know how to calculate the notional value if you wanted to hedge your entire portfolio or even a portion of your portfolio versus any type of downturn that you anticipate in any market indice. So we can do that with ETF options. We can do that with index options. So we're going to talk about that today and kind of expand on those advanced concepts that we've been discussing throughout the month of February. So without further ado, let's dive into the details of this one. I'm not going to review the previous this time, but go over the intricacies and what you need to know. So what we're going to talk about, if we're looking at our portfolio, we have to understand beta weighting. So I'm going to go through another Greek, this one not necessarily specific to options, but looking at the beta of your overall portfolio. Every security has a beta. We'll talk about that in a little more detail. Oh, and these numbers don't match up. So we'll go through that. We're going to talk about long puts, covered calls, option callers, and portfolio hedging. There is a very specific strategy that the JP Morgan hedge fund does and a mutual fund does. We're going to talk about how they would structure that. That way you can hedge against downturns, but also pay for that utilizing an extension of an option caller, if you will. So it's a combination of all of these strategies put together that's going to create the entire portfolio hedge that we're talking about. So the intent and the goal of today's session is to understand how to assess your overall risk of your portfolio, portion of your portfolio, then to utilize options to mitigate risks for a period of time because options have an expiration date. Therefore, we always specify for a period of time and can adjust accordingly. All right. And looks like I didn't have the disclaimer slide, but I'm going to say it for you. This is not this does not constitute financial advice. It's purely for informational and educational purposes only. Options are complex and are not for everyone. It's important you know the characteristics and risks involved with options. Yes, I do have that memorized. And yes, we'll absolutely talk about managing the cost of hedging, how to mitigate it, minimal cost, all of that we will absolutely cover today. But what we need to talk about first before we dive into those details is beta. Doesn't matter having a look at the entire beta equation, but I think it's for those math folks out there, something to pay attention to and certainly helps understand the concept of it. So whenever we're looking at the market, I like to describe it as getting on a roller coaster. So this is taking a step back from options and we're just looking at the overall market, perhaps even specific sectors or stocks, because that's what makes up the components of those indices or indexes, right? It's a roller coaster that goes up and down depending on how risky it is. It's a measure of volatility, really, is what it is. And securities or indices that have a higher beta tend to have higher risk. And I think volatility has a really bad reputation. Something with high volatility is something that's necessary for growth, meaning increased volatility is for the upside and the downside. So tech sector, for example, or Tesla even, or NVIDIA even, has a higher beta. It has a higher beta because it has higher growth potential. It moves more than the market. That's what beta means. And we'll go through some examples in a little more detail. But if it moves more than the market, that means on both sides, as in it can move up more than the market, can move down more than the market. So that's your volatility or systematic risk. But volatility has a bad reputation. And I think it's oftentimes misused and correlated with a downturn because oftentimes people panic more than they're excited. Just the human nature and psychology aspect of the stock market. Nonetheless, we're going to measure the volatility or systematic risk with your entire portfolio and compare it to its benchmark. And that could be your benchmark. And we'll talk about what those are, but you got to understand how to find something that will correlate. All right. So here is a beta of SPY, and this is a 5-year beta. This is going to be your market beta, something that we look at very specifically as the broader market tends to be the average benchmark. If you're a hedge fund manager, wherever you are, if you're beating this benchmark, you're doing better than the market. That's our commonly used measure of the market. However, that may not be your intent, or that may not be the concentration of your portfolio. So, meaning we need to look for something when we're understanding, what do I want from a hedging perspective? What is my beta risk? What's that comparison? Meaning, if you have a portfolio that does not exactly mirror the S&P 500, hence the SPY option that I have on the screen, or the SPY ETF, then it's not going to hedge you as much as you realize. So we have to find something that has a better correlation to your overall portfolio, or at least the systematic risk that you've identified. So it could be even a pullback in tech that you see, a pullback in Russell, a pullback somewhere that you have exposure to that you want to mitigate. So this can also be sectors, and it doesn't have to just be overall, but nonetheless, you need to look for a high correlation. So the S&P 500 is the beta of 1. That's going to be the benchmark. And when you pull these type of numbers, that's what you'll see. If you look at something like the QQQ, which represents the NASDAQ 100, that has a beta of 1.24, which means it's 24% more volatile. It's going to move 24% more than the market, and the market's the S&P 500, and that's up or down. Tesla, 0.64, 1.64, 64% more volatile. Makes sense. Those are moving stocks. When Tesla goes up, it goes up, and when it goes down, it goes down. We know that. And tech is certainly the same, but not necessarily as much. SH is an inverse correlation to the S&P 500. It's not exactly 1-for-1, but very, very close. SPUU is a 2 times leveraged ETF, so it's going to be 98% more volatile, and that's going to make sense. And then you've got something like Procter & Gamble. That is a 0.5 beta. It's 53% less volatile because it doesn't move as much as the market. So these are examples of an inverse leveraged, highly volatile sector and a highly volatile stock, and a very less volatile stock like Procter & Gamble that falls into those consumer staple type of categories. If we're looking for your overall portfolio, this is how I would try to understand the correlation. Normally, you can find a beta of these specific securities when you put in the quote at your brokerage firm. It's there in one of the detailed quotes, but here is how you understand your correlation here. A high correlation is just 1-to-1. If it has higher volatility, then that's going to be higher. The numbers, no correlation. If we're at 0, inverse as soon as it goes negative. So the math there is extremely, extremely straightforward. Making sense so far? I know this is a different subject than normal. If this does, please give me those thumbs up. Thank you. And the heart. So the emojis are fun. We're going to stick with that. All right. So let's talk about long equity puts. This is whenever we are hedging a specific security, this is normally the strategy that we begin with, but it comes with a cost. We know how these work. I expect you to know how this works if you come to this session. I'll give you a quick overview. Nonetheless, when we buy a put, we're buying the right to sell something, and we have a specific expiration period with that. And what happens is it gains the security. In this example, ABC, we've got the right to sell at 150. We paid $7 for that. Just looking at the intrinsic value, so executable value component of this, as ABC goes down below 150, this is going to gain dollar for dollar. So if you pair this with something that you already own, you lock in your gains for a specific period of time, which is the expiration date, for a cost. So individually, we know that if we're buying a long equity put, that we need it to move where it's a bearish stance, but we need the stock or whatever security is the underlying derivative is derived from to move just as much as the premium. That is what makes us profitable. So we have to take into account that cost, meaning if you're trying to lock in a gain at a specific time frame where you can capitalize on any losses, they just won't mitigate because your underlying stock position is going to go down in value, but your long put is going to go up in value. However, you're going to have this danger zone, which is the $7, meaning you're going to increase your cost basis really, or the capital spent for those 100 shares of ABC that you own. That's the cost that comes with this insurance. But this is what I like to call level one of hedging. You can do it on a stock, you can do it on an overall indice, but before you do that, you want to look for something with a correlation. That's step one. And that's really expanding it. But when you first learn how to hedge, it's buying the shares. So you own 100 shares, and maybe it's Apple. So that's something that you want to own. You don't want to sell it. Perhaps you even have a capital gain that you want to be cognizant of, tax events, whatever your reasoning is. Creating something like this helps lock in gains for a specified period of time if you're afraid of a downturn, but it always comes with a cost. Options have a give and a take. The give is downside protection. The take is the cost for that downside protection. But there are ways that we can mitigate that with more gives and takes. It's the beauty of options. We layer everything together, and we'll talk through that a little more detail. All right. So let's talk about a covered call. We know how these work. We own 100 shares of an underlying security. We have a covered call. We're selling the right to buy, which means we have the obligation to sell. So both of these involve the sell side of the equation. That means that throughout this expiration period, we're required, or not required, but obligated to sell those shares at any time through the expiration period, and we receive a premium for that. So the key here is we're choosing a strike price that we're willing to sell our shares at, because the give is that premium, which reduces buying the shares. So in this case, $100, we reduce it to $95, but we're allowing ourselves upwards potential of $115. So you can see how technical analysis really plays into your thought process here. And we can certainly bring up some examples if that's something you guys are interested in. But that's the intent of the covered call, is I own stocks, I cap my gain potential, I reduce right here. The difference between these two numbers is the premium you received. So you reduce your break even, which is reducing the capital that I'm spent. And in return, I'm obligated to sell those shares. So requirements: own the stock, sell a call, my stock becomes collateral, I receive a premium, I'm obligated to sell that ETF or stock at that specific price at any time through the expiration period. Now, this is just another example of the same type of concept here. When I own a long stock, so here's how we're going to layer it all together. The most that I can lose is the amount that I spent, right? The max loss is $51 per share. My max gain theoretically is unlimited. It can go to an infinite price. That's why we want to consider the beta, because and thinking about your strike prices, it's extremely important and helpful. However, my substantial losses, they're limited to the total cost. I can only lose as much as I spend. Every time I say that statement, everyone there's always a comment in there that, oh, no, but I'm not including margins. So for those thinking that, good try. But if I we're layering everything together now. So now I own this stock at 51. I am maybe perhaps a little wary of a downturn. I am afraid that we got that PCE number today. It was hotter, but that was expected. But now that we're out of earnings season and we've got this wait until we're going to hear something more from Nvidia that's driving the market, or there's some other data that perhaps you're concerned about and you want to add on some protection. So we would perhaps buy that long put at a strike of 50. It costs you $3.20, but now you are protected for a certain period of time, because remember, options have a expiration date attached to it, but you've increased your cost now. So now the most that I can lose, instead of $51 a share, is an additional $320 altogether, or $54.20. My losses are protected if it goes below 50. So there's that $1 of danger zone, but I can still have my unlimited profit potential. It's still there because I own the stock. There is nothing capping it. If you own a put, you own the right to exercise and sell the shares. You don't have to. That's entirely up to you. So let's add on a short call to that. Let's say you are utilizing technical analysis and you see a resistance zone. And mind you, I would not draw a resistance zone here, but let's pretend that was a really good one with multiple touches, where you are willing to sell the shares at 60, or you have got a adamant view, whatever your process is to determine that next stopping point, what you could do is sell a call utilizing your shares as an obligation because they're not necessarily tied to this put. Because remember, the put is something you choose to execute upon, whereas the short call, you're the passenger on this. You're obligated to sell the shares. But we now have protection. You had your protection of $1, but now what you're doing is you're selling a short call, perhaps a little higher, so we can still keep some gain potential, but that reduces the cost of your protection. And that's the way that you can. This is level 2. There's still more levels. We're gonna level it up once more. So does this make sense so far? We've mitigated our loss. We've for a specified period of time. We've reduced the cost of the long put, so we're just really building on it. That's the give. The give is reducing the cost of protection. The take is capping upwards potential. This is called the options collar. Very useful if you are expecting a downturn or if you have a very clear area of resistance. And maybe not necessarily too high beta of a stock, because remember, it's upside potential that you are giving up, and volatility involves upside and downside. So let's talk about the intent of portfolio hedging and what we would do with those two strategies. And I'm going to add on another layer. So when we're hedging, you are protecting against a market downturn. I just gave you an example with ABC stock. That's something you can certainly do with an index. But what gets complicated is, remember, you can't buy an index. You can only buy an ETF that mirrors the index. So if you're doing something like this, it'd have to be a credit spread that you'd have attached to this. Otherwise, you're going to have unlimited risk potential if it goes really, really high. And that's also, I want to look for the correlation, but it's when it gets to a little advanced there, but we can certainly talk through it and go through notional values if we need to. You're anticipating a decline on an underlying you own or a specific sector. The trade is the first one we discussed. That's called a married or a protective put. You might see that somewhere. Your options platform may pair it together like that. That's what you will see. And then the other one that we added is a collar. You do a protective put if you just want to keep unlimited upwards potential, but you are just scared for the downside within that expiration period, and that's how you choose your expiration date. And then you use a collar if you have a clear area of resistance where you want to lock in a gain for a specified period of time, but you are okay selling your shares at a specified price. And that's the addition of the short call. Those are the names. And if you've attended my sessions before, I think there's over 72 option strategies. There's new ones added all the time. Options will do what they do. They're logical. That's why I love them. We can wrap our brains around them. Doesn't matter what you call them. You just have to understand how they work. All right. So example, got my stock at 520. I apologize. This is a real stock, but I removed the name of it. So we buy a long out of the money put at 510. It's going to cost us $12.50. Remember, this is our danger zone here. We're only protected if it goes below 510. Well, short in out of the money 540 call. That's going to capture 1210. And remember, these are real prices. So this is the actual prices at the time that I pulled this with the same expiration dates. That is virtually right here, even though there is a $10 period or $1,000 that I would not be able to be protected for the stock that I own. However, it's going to cost me all of 40 cents per share. And that's a real example. You can also layer this together. Know that you don't have to buy the put and sell the call at the same time. You can certainly do it in different environments. You could have a covered call and just add a long put. The give and the take. Think of it that way. Now, the way that we can mitigate this even more is if you see, so notice how this one is a little more charting involved with it. This is where we bought the stock at 520. We're choosing an area that is a clear area of resistance where we're willing to sell the shares at 540. This is where we're deciding to have our protection because we say if it drops below 510, that is going to fall. And I do not want to have that much of losses. So I'm willing to pay 40 cents for that. But maybe you want to get a credit in this case where you say, you know what? I see that This right here was an area of resistance, which is now support. And I do not think that this is going to fall lower than 480. So here's your give is you're going to get another credit. So you're actually gaining money putting this strategy on. You're creating a debit put spread with your covered call. But that's the give. The take is, so this is a way you can still keep that premium from options trading. If it goes below 480, you are not protected. You're only protected to a certain level. So essentially what we're doing here is you're utilizing the caps that are created with short options. And that's why it's called a collar. Literally I think of it as it's because I'm looking at my dog that's trying to get into my office right now. It's literally wrapped around the stock. It collars it and it protects it. And that's the intent of this strategy. And again, this right here, the call will be considerably more margin if you do not own the long stock. That has unlimited risk potential. So the way to offset that is buying an even further out of the money option. And remember, the less valuable the option is, the less expensive it is. All right, let me go back to that, make sure that makes sense, because that's the crux of understanding and wrapping your head around that. So does that one make sense? Any questions on that? I always feel like I'm flying through them, but it's actually been a bit. Great. And Gerard, I'm going to answer your question. So that's a bet that the stock does not go lower than 480, but if it does, I can buy the sold put back to have further protection if I think it's actually going lower. That's correct. So that you absolutely could roll down in that case, but that's going to cost you. So this is a bet, or you're only hedged down to 480. So you're limited to an expiration, but if it goes lower than 480, you are not protected whatsoever. But you could buy to close that short put and then sell to open another one. And I'm sorry if I'm moving fast. If we need to go back, we certainly can. I'm happy to do that. Have a big coffee in front of me, and that's probably what it is. All right. So what are we going to do if we want to do this in our overall portfolio? We have to understand our portfolio composition. We're working at some really cool, innovative tools at OptionsPlay and a lot with your favorite brokerage firm, but we don't have a portfolio composition yet, but a lot of them do, and they're normally found in your active trader platform. So Fidelity's Active Trader Pro, Merrill's Merrill Edge Market Pro, those are where these are found. So if you're looking for what is my portfolio's beta, that's where you can understand where it is. You need to select an index with a high correlation if you are looking to utilize the entire market or your portfolio specifically. Because remember, you want to tailor this to your individual portfolio. It's highly unlikely that you have a portfolio that looks like the S&P 500, but if you're utilizing technical analysis and you're looking at some major indices, you may say, you know what, I know there's going to be a pullback during this time, or I'm really uncertain about this environment and I'm just going to add some protection. That's one way to look at it. Then you determine your hedge ratio. So what proportion of that portfolio you're looking for? What should that be hedged? Literally the dollar value is what you're looking for. That's how we get the notional value. Then you calculate your put and call contracts required. So the number of index options is your portfolio protection amount divided by the index level and times the contract multiplier, which is normally 100. But sometimes if you're looking at index options, they can vary. But just that notional value makes it look more complicated than it is. Know that this is an ongoing process. Market conditions change, especially nowadays. It's a very interesting market. I was talking to one of my friends the other day, Jay Woods, and he had a lovely newsletter. And he said, and he's been working on the floor for, I don't know how long. I want to say for very long. He was there around 08. And he said the hardest markets to trade are those that are just aggressively bullish. It's constantly going up. And that really resonated with me. So, meaning it's an ongoing process and market conditions do change. And it's just important to pay attention to that. And that's why we cover market events at OptionsPlay in addition to hedging and how to implement strategies because they're all related within the grand scheme of the market. All right. And then that's the end of it. So I know I really did fly through that. Is there anything specific that we want to go through again? Do we want to look at building that collar once more? I saw some comments in there that said, "Hey Jess, you went a little fast, so let me know." All right. So shorting the put, what is the collateral since you use the stocks you own towards the covered call? That is a really great question. So the collateral that you have for the short put is your long put because your short put is an obligation to buy. And normally that is covered by cash. But what we're covering it by in this case is with the right to sell. Okay. And how does beta factor into determining how to set up the collar? That's how you determine the underlying security to set up the collar. So, meaning if you are looking at index options, and I've got a slide on index options, we can pull that up and look at their differences. So, meaning if my portfolio is very tech heavy, extremely tech heavy, because I can afford to be aggressive. So, I am not going to use SPY or SPX. And there is some advantages by using index options versus ETF options, because remember, index options are cash settled. Does anybody need me to explain what cash settled is? I will anyways. Meaning it reduces that risk of early assignment because most of them can only be exercised on the day of expiration. And when that occurs, it's just a difference of the cash if you would have won or lost, quote unquote, and you're not exchanging shares. And that makes it easier because I'm mitigating or completely taking away early exercise because they can't be exercised early. But if your entire portfolio is something that mirrors the QQQ, instead of using the QQQ as in the ETF, unless I literally own the ETF and am setting up a covered call that way, I would use index options. And NASDAQ 100 options even have variations that make it a little bit easier, meaning there are micro options because the NASDAQ 100 is a little more expensive. So there are options that are 1/10 of the notional value that would allow you to be a little more capital efficient. So that's the way I would set it up. So meaning if I want to protect, I'm gonna have to do some easy math from a brain right now. But let's say you have we've got like $100 strike price for a index option. And I have got a whatever my portfolio is mainly tech heavy. And I want to mitigate against a downturn that I potentially see in tech. I want to hedge that with all of my market commentary. I don't see a downturn with tech right now. I see some trends waning, but the action today looks like my confirmation I'm looking for is absolutely fine. But if I did, then I would use something like the NDX or XND options, which are the micro options that are going to allow me to take a portion of my portfolio or all of it. So I'd look at my notional value, meaning if my portfolio altogether was $100,000, I would make sure that the notional value of the options is worth $100,000. That's how you properly hedge. Now, that is extremely capital intensive for the overall portfolio. So it could be a portion of your portfolio, but that's how you would look at it. And the notional value just means literally the dollar value. So it's 100 times 100, right? Does that make sense? Next time I'll put a slide together on that. This was a newer one, so we reiterate. And Rudolph has a question there. If I've got a portfolio of 1 million, it means that I would have to buy individual puts correlated with composition of categories, i.e. sectors. I mean, not necessarily, but if you want to hedge the entire portfolio, absolutely. But remember, you can hedge certain portions of it. You don't have to do all of it together. If you're and the market doesn't tend to work that way anyways. You may have meaning if there is a sell-off in tech, there's probably some buying in consumer staples and healthcare. So it just really depends on where you feel the market's going to be. Is it going to be cyclical or what's happening with the market if you're going to do this overall? It's very common for hedge funds and mutual funds to do this, but know that those are very capital intensive type of products. And then Jim has a good question in regardless to time frame. That's up to you. It's so we have some best practices with options that help you capitalize on your premium, but we're not looking, the intent of these strategies is not to capitalize on premium or the theta decay aspect. The way that this is structured is actually, that's why I wanted to go through the Greeks before we even talk something like this. And I know I don't have them on the screen, and I can pull up the slide if we need a refresher. Go into the other one. Hold on. All right. So we're looking at credit spreads or covered calls. The best practices here for short options is always 45 days until expiration, because that allows the theta decay, which is positive for short options, the daily time decay. It allows you to have that adequate premium. But we're creating that neutral by offsetting it with the long option. So, when we talked about theta is centered around at the money options, which means theta is going to be the highest for this 510. Adding something further out of the money, which is 480, that put is farther away from the current price of 520, whereas this 540 is further away, meaning this is the highest theta. The addition of these two is going to take this negative theta and make it probably flip it positive or relatively close to, but actually you're going to end up with a neutral theta, which means that 45 days until expiration best practice is not something to be too concerned with, because we're not focusing on getting the most from our premium. We're focusing on hedging for a specified period of time. And so when we're thinking about days until expiration and choosing that expiration period, the mindset for this is, how long do I want to be hedged? That's the intent here. Neil is asking a good question there. So, for an average investor, the simplest strategy is to sell covered calls to protect downside. But can you also buy a put if you are comfortable with adding more capital to the trade? Yes, that's a caller where you just remove this. So you may have a covered call where you are adding 1210. So you're reducing your cost basis of this. Let's say you bought it at 520 by $12. So that's the capital that's spent. If you want to spend that capital, that reduction, then you can buy this put. Maybe it's right at the money. It might cost you a little more, but all that does is locking in gains for a specified period of time. If it goes down further, you own the right to sell the stock. So you could close this option, because remember, a short call is going to recognize its maximum profit potential if it expires out of the money, which means lower than the strike price. So right at 540, that's the highest we want it to go. But say it's going lower, then that means you're going to keep all of this premium. And if it goes lower, you own the right to sell. So you could actually enter exercise instructions, but all in all, you should be able to close it out in the market for all of the intrinsic value. Nonetheless, that's how it works, though. That would be the simplest approach. And that's how you would hedge. Shorting, adding a covered call it's not hedging you from a downturn, but it is reducing your capital spent. And the intent of doing covered calls consistently is you're not doing that on stocks that are extremely growth oriented. You're doing it on stocks that you feel will hit a certain amount within a certain time frame. So it's that almost trade slow and trade often. All right. But yes, that's absolutely the way you could do it. And remember, you don't have to execute this all at once. You could own the stock. Then you see that there's a nice up day. So that's probably when puts are going to be cheaper because the market's going up. But then you would add your long put then. So, and also the calls should be a little more expensive there too. So you could on that up day say, you know what, I'm going to go ahead and add some protection because we're a little exuberant at this moment. That would be a way to kind of capitalize on the way that options are pricing. Mario says, if I own 100 SPY, could I sell one SPX call? No, you cannot. Because SPY is an ETF, SPX is the index, but you could sell an SPY call, but not an SPX call. I mean, technically, if you have portfolio margin, it should work that way with risk, but that's not the way it works. It's just the rules. Do you recommend creating a hedge simultaneously with buying a stock? Well, why'd you buy the stock in the first place? That to me seems like a cushion because you're perhaps afraid of that risk and getting on that roller coaster. Because once you own stock, you are accepting substantial risk potential. So you are buying the put if you're afraid of it going down. But doing that continuously is going to end up increasing significantly the amount of capital that you spent. So even though you'd say, you know what, this is great. I'm going to buy puts constantly to protect me on the downside. Well, if that's costing you, then it's not going to help you in the long run. You're increasing your cost basis rather than reducing it. And if you have the short call, yeah, this is only going to cost you 40 cents, but that's still a cost. And you're giving up your upside potential, yes, for some downside, but you're really, really minimizing the growth aspect of your portfolio with something like this. All right. The registered accounts would not allow you to sell puts. Which strategy could be used for those accounts? Um, not sure what you mean there, Oleg. Perhaps there's a certain account where you can't sell a put. So this one we're doing with a debit spread, and there are some accounts, depends on your brokerage firm, that will allow that in IRAs. You have to have limited margin, but does involve having at least this entire strategy does involve at least you having limited margin. Oh, IRAs in the US. I see. Okay. Well, I answered that right. Thank you, Bob Delaney. Then that means yes, the limited margin. I know at Fidelity you can have limited margin on your IRAs and you can execute something like this and have debit and credit spreads. All right, let me go through the Q&A. Jim asks, can you have an active stop loss instruction at the broker to prevent a substantial loss at the same time you have the hedge on? No. You normally would not be able to do that. That does vary broker by broker, but at the ones that I worked for, which were most of them, whenever you have a stock tied to a order of some sort, you can't even sell a call against it. It'd prevent that because the stock becomes collateral for the short call. And if the stock is collateral for something else, like a limit order or a stop loss order, any type of order, it doesn't allow you to you double use that collateral. So no, you would not be able to do that. Prakash, was that a statement or a question? Oh, a statement. That must be new. That is nice they got that. Neil asked, I'm not sure if I missed it, but institutions use a combination of all strategies talked about today. Yep, there's a famous mutual fund by JP Morgan. And it's very interesting. You can pull up an options chain for SPX and actually see where this is, but they have protection 5% down. It's like the 5% width on SPX. So they're protected from a 5% downturn, but they also have enough room for a 5% upturn utilizing a short call and a debit put spread. What is a good hedging strategy if the stock is in red by 10%? So remember, when we're deploying a hedging strategy and it's on an individual security, we'd want to do that before it reaches that in red by 10%, which is, I know, something you don't want to hear. So, meaning you're creating a neutral strategy, but you're short term neutral, long term bullish, because the intent is not to hold this forever. So, the same goals that are created with a covered call, short call, the addition of the short call apply with this type of hedge. So, if you're not bullish on the stock, that's the first question I would ask. If you are, remember hedging is going to cost you, which could put you in the red more. But what could, if you are bullish and you think it will come back, again, that's your personal preference, you could sell short calls, which are capping your upside, but that's also going to reduce the cost in the long run, unless you're called away. But that consistent income, because that covered call strategies are work really, really well in neutral to bullish environments. So neutral to bullish. So that's why we say, are you still bullish for a covered call? We're just adding some neutrality to it. Okay. Question, is the series archived by Jose? I believe these were posted to YouTube, the previous one, so you should be able to see that there. And then this one will be posted later. And then if you want a copy of the slides to sit and stare at them, you just need to be on a free trial, and we'll send those out to you via email. Govin asks, I apologize if I said your name incorrectly there. What is your best or favorite indicator to pick a strike price? So, Govin, I'm a technical analyst at heart, but I really like looking at areas of support and resistance is number one. I'm a long-term investor, so I always look at weekly charts, but just failures to make a higher high or making a lower low, then that, if that's hit multiple times, then that's adding strength to your resistance. And I manually draw those. If it's something that's rallying, I'll use Fibonacci extensions. I also tend to use that in general, and those lines come together. And then I like to use the 13, 26, and 40 weekly moving averages. Those act as support and resistance as well. And then other indicators on top of that that show me momentum, trend strength, so on and so forth. We can certainly have a technical analysis session if that's what you guys are looking for. All right. Thank you for the wonderful compliment there, Neil. I appreciate it. Okay, we hit 5:02, which means it's time for me to do 7th grade math homework. So really excited for that. Um, this is going to be the end of the February season. So make sure you sign up for next month. Tony's going to be stepping in. And then the following month, which is going to be April, cannot believe it's April already. This is the time where I'm going to sit here for 2 to 3 minutes and you guys can type in the chat what session you guys want to see next. I see Lauren says technical analysis. Thank you for the kind words. But if there's any, and I also have that previous survey I sent out last time just to see what you guys want. And this one was definitely inspired by you. So let me know what you're looking. Zero, lots of technical analysis. I think we're going to do technical analysis. Zero DTE. Sure. And the Greeks again. Why not? Okay, great. Risk reversals. That'd be a fun one. Okay, got that noted. Thank you so much for the kind words and bring all that information together. Always appreciate these sessions with you guys. Let us know if you have any other questions. You can always send a message to info@optionsplay.com. Phil, who is the wonderful person on here managing the chat and giving everything there, if you say, get this to Jessica, he will do it. And sometimes I don't answer, and he'll do it 6 or 7 times if it's taking a moment. So please know that we will get back to you and really appreciate the time. I hope everyone has a wonderful evening, and I will see you in April.